Traders live and die by the quality of their trade ideas, irrespective of prevailing market conditions. In this workshop, we discuss the drivers behind share price movements, a trader's thought process, the trade idea generation framework, and all the elements of a good trade idea. We focus on the ISM Manufacturing Report in the US to identify inflection points in industries. I'll showcase my own process for interpreting these reports, finding emerging trends, and using them as a source for trade idea generation. We'll also cover how to use all these insights generated at an industry level to move down to the individual company level to find the best trade idea. Do like and share this video with your friends. To learn about generating your own edge in trading financial markets, subscribe to the channel for many more such valuable videos. Let me know in the comments section how you found this workshop. Sit back, relax, and soak it all in. This is not financial advice. Do read the disclaimer. This is purely for educational basis. So last week we discussed a whole lot about how a trader views the world and what's literally the job of a trader. And the essence of the conversation last week was that trade idea generation is critical. There's a reason for that, because as traders you tend to have shorter term time horizons, so 4 to 10 weeks roughly. And by definition, this means that after a maximum of 10 weeks, the idea is coming off the portfolio. So you need new ideas to add to the portfolio. And if you don't have a research process that generates trade ideas and high quality trade ideas at a relatively good cadence, then you're going to be stuck as a trader, because you'll have a portfolio that's not being refreshed with new ideas and it gets stale, and eventually you'll see that in your returns as well. The market environment can change multiple times within that time horizon. So as traders, we need to be in sync with the market and readjust our portfolios accordingly. So if we don't have a good actionable watch list with both long and short trade ideas, then we'll get stuck, because we won't have the number of ideas that we need and the variety of ideas to be able to adjust our bias in the portfolio. So the typical retail trader is more on a hamster wheel, whereas good seasoned traders tend to have a flywheel of ideas. So it's kind of day in, day out, almost in any market environment, we do find things to do. And that's the type of good behavior that traders need to have day in, day out to be successful in the market. You can watch last week's presentation to get a little bit more insight into this slide itself. So as short-term traders, basically what we are focused on is the left corner. Markets move for various reasons. Over different time horizons, these reasons vary, right? But we are more involved in a short-term basis, so 4 to 10 weeks roughly. The share prices will typically move because of shifting future expectations for different companies and industries. There's a little bit of sentiment as well that moves the share prices. Liquidity conditions also tend to be another factor, although it's not something that we focus on a daily basis. But there are phases where liquidity conditions will cause share prices to go up or down, and we have to be very well aware of that. Of course, the macro environment is something that keeps us awake every single day. So we don't make bold bets on the macro environment, but we kind of take it in and understand what's the backdrop of the macroeconomic environment and adjust our portfolio accordingly. So basically, as a trader, what we're trying to do is understand the status quo. So this is where we ask ourselves, so what's been happening in the stock over the last 6 to 12 months? What's the prevailing narrative? What are investors' expectations? And what are analysts saying? Are they upgrading, downgrading the stock, and for what reasons? So we establish what's the status quo for a particular stock and even its industry. And then we try to look at the factors that are changing or that are going to change over the next few months, because these are the factors, these ones are the factors that will actually cause the share price to move from here onwards, right? So we need to understand whether demand is increasing or slowing down, whether that's an industry-wide phenomena or just for that particular company that we're looking at. We also need to understand the type of risk on or risk off sentiment within that particular industry, because as an example, if you have rotation of capital from value to defensive stocks, it would be a little bit crazy for us to be long, to go long value only, or to have long value and short defensive stocks, because let's say the quants warrant for something like that. We're not going to argue with the market. If the market says it wants to be risk off for the next 6 weeks, we will adjust accordingly. We're not going to have all of our ideas in one basket and argue with the market. So these are the factors that keep changing. Of course, there are other factors like inflation could cause raw material prices to go up. The opposite is also true. If raw material prices are going down, what does that mean for margin for the company? If margin is going to go up as the raw material prices go down, that typically means that the company will see higher earnings. So there might be an opportunity to be long that particular company. And these are the factors that we keep evaluating. At the end of the day, expectations of the future will move the share price. And as traders, this is where we are typically focused on, because we want to be ahead of everyone and position ourselves as everyone is still sifting through the different information, and then we'll be making the decisions to go long or short a particular stock, right? So this is basically what I mean when I say expectations meet reality. So we position ahead of time, and then 4 to 10 weeks later, we're taking off these positions from our portfolio, whether they've worked or not. So what's the anatomy of a good trade idea? As I've mentioned a few times now, our trade horizon tends to be 4 to 10 weeks. That's a lot of trading days to allow us to make relatively good returns. The volatility within that time period is enough for us to be able to make significant returns. We, of course, express our views in different ways, whether it's just buying the stock, shorting the stock, or the more sophisticated traders out there, like myself, will be structuring the trade using options, and we'll try to capture the volatility that we see in the stock over the next 4 to 10 weeks. We tend to look at ideas that are rich in catalysts. So, of course, quarterly earnings for a company always tend to be a good catalyst in itself, because at earnings, a lot of information comes out, both quantitative in terms of KPIs, revenue, expenses, earnings, and so on. But you also have a lot of commentary, so qualitative information that comes out that need to be assessed in conjunction with the quantitative information. So a lot of this information needs to be digested, and then you'll see the share prices move one way or the other. So of course, that's a catalyst-rich period. However, I need to make a point here that as traders, we are not what I call earnings junkies. We're not just playing earnings. We want to have opportunities throughout the year. So if you think about it, you will have earnings every quarter, and it doesn't mean that 1 month before earnings, that's when you'll tend to be active and have positions, and then once earnings are over, you'll just go hide under your bed. That's not the model. So we need a mix of ideas that involves earnings, that are pre-earnings, post-earnings, during earnings, and ideally we want our catalyst to not just be an earnings play. So keep that in mind. It's also something that we focus a lot on when we are looking at our portfolio in terms of diversity. So that's another factor that also needs to be diversified. And you will never hear about this. This is literally never spoken about. When we talk of diversification, people just talk about, yeah, you need to have diversification in terms of industries, in terms of, let's say, type of company, whether it's value, growth, or defensive, cyclicals. Some of the slightly more sophisticated traders will start talking of different factors in terms of diversification across market caps, diversification across beta, PEs, and so on. But the real guys who are trading the market and have done this for many, many years, we know what the true risks are. So as an example, if I have a portfolio full of ideas that are just lined up for either an earnings beat or an earnings miss, then that's a significantly risky position to be in, because we've seen so many companies that they beat earnings and then they still sell off. Or the other way is also true. The opposite is also true, where companies miss earnings, but then the share price goes up. There are many reasons for that. It could be that it's purely because of positioning going into the earnings. It could be that the market is now looking ahead for other things. It could be that management has indicated that something is in the works. So a lot of the people who are bearish have now closed their trades and moved on, and maybe the idea is attracting new capital, so new longs. So there are a variety of reasons, but at the end of the day, if the portfolio is purely related around earnings, then that's a very tricky position for you to be in. At the end of the day, what we want is ideas that are rooted in fundamentals and that have a lot of catalyst, and if it involves quarterly earnings, that's even better. We tend to also look at other market moving news. So for instance, industry reports. As an example, if I'm looking at CarMax, which is a car dealership, I want to see the industry reports that talk about used car values. I want to see the industry reports that talk about what's happening to inventory in the industry, across the industry, what's happening to, let's say, auctions, what's happening to selling prices in new cars versus used cars. So all these industry reports come out on a monthly basis, some are even on a weekly basis. And depending on what idea you're playing, you would identify these reports and kind of keep an eye on them, right? Because as the information comes out, that might start impacting the share price of the company you're trading and even its industry. Another piece of market moving news tends to be competitors' earnings. So as I've mentioned, earnings tend to be a very catalyst-rich period. So if you're getting information from your peers and they're saying things like demand is actually slowing down much more than what we thought, and it's an industry-wide issue, chances are your company will also be affected. So if you're long that company, you need to be aware of what the competitors are saying. And there are many other things that will not just be company specific. So for instance, if competitors are saying that raw material prices are increasing or decreasing, that will tend to be true for your company as well. So it's for you to evaluate to what extent whatever the competitors are saying will also impact your company or the company that you're trading. And what does it mean to your thesis, whether that validates the thesis further or whether it's invalidating the thesis. So that's why as traders, we're always on the lookout of these types of information that either confirms or disproves our thesis. And if we have a position on where we believe the thesis is being invalidated, then we should not hesitate to take it off and replace it with a new idea. We also want stocks to have the right characteristics. As an example, if we are looking for longs, we tend to look at companies in the mid-cap or even the small-cap segments. That's because if you're long a company, you're typically looking for increase in earnings power. So the smaller companies have more room to grow. Typically that's true, which means that if you're able to identify a few of the companies that would tend to be outperformers within those segments, you could do really well in terms of finding long ideas that work extremely well for you. When it comes to short, it's kind of the opposite. We normally want to be looking at larger caps, mega caps for shorts. We also do short mid caps, not necessarily small caps, but whenever we deviate from this rule, there must be very, very good reasons, very strong catalysts that are showing that, it's an evident short. But as a general rule, we try to stick to large and mega caps for shorts. The stock also needs to have a good volatility profile. So we don't want stocks that barely trade. We don't want stocks that no one is really like stocks where no one is really paying attention. We also don't want stocks that have, let's say, very low analyst coverage or very low institutional ownership or coverage, because if it's not being traded, then chances are, irrespective of what information comes out, it's unlikely that this information will be priced into the stock as quickly as we anticipate as per our thesis. So we have to be very careful about this. A lot of times I've got mentees who come to me and say, this is what's happening in the industry, in the company. I believe the stock can move by 20% after earnings. And then you look at the stock, or you only need to pull up the stock chart and you're like, I don't think that's going to happen. That particular stock does not have the required volatility profile to move by this much in this short amount of time. So whenever you're looking at a particular trade idea, you have to be realistic also in terms of your expectations. To expect a stock to move 15, 20, 30% is a big deal. So you have to have enough evidence that the stock has this particular volatility profile to achieve what your expectations are. We also want stocks where there's adequate information and the updates are quite frequent. As traders, we always want to understand what's happening in a stock, what's happening in an industry, and we use the KPIs, investor and earnings presentations, press releases, SEC filings, and so on to build our understanding of the status quo, and also to kind of predict what could happen in the future based on the backdrop that we are seeing. So if we're looking at the company and it doesn't provide the level of information that we believe is granular enough for us to kind of understand things with a great level of detail, then there's a lot more uncertainty in terms of the predictions that we can make, right? And it will come to a point where you'll have to say, okay, I think this could happen for the company, but I don't necessarily have the right level of information to drill down and understand whether I'm seeing confirmation signals or not. So I'd rather leave this company behind and look at something else. And that's a judgment call that you'll have to make. There are many companies that are just boring companies that do nothing. They don't trade, they don't provide enough information. We're still looking at, let's say, old PDFs, and maybe there's like one update per year when it comes to investor presentations. On earnings, there's barely anything that comes out. So these types of companies are not the best to look at when you're trading, because the information is just not out there. And sometimes you have management that's not helpful, management that's not communicative enough. So you might also see these companies don't issue a lot of press releases. So, as a shareholder or as a trader, if management is not communicative enough, it's not giving you a lot of information to be able to understand what's happening under the hood, and on that basis make predictions about the future, right? So if you find yourself in this particular situation, just leave the idea behind, find something else. The US market is big enough for you to find ideas in many other different segments. You never have to kind of compromise on these factors. We also preferably want the companies to be listed in the US. The US has the deepest, most liquid tradable market, and the quality of information is probably the best in the whole world. The frequency of information is also good enough for us to have trading opportunities. The US is also a highly tradable market. For instance, if you compare that against, let's say, Asian markets or smaller emerging markets, those tend to be a lot more investor centric. So capital doesn't move that much. You will predominantly have pension funds that have positions for multiple years, and the share prices also do not necessarily have the kind of volatility profile that we seek to be able to give us the right type of of opportunities. Let's now take a view on how we generate trade ideas. So there are multiple ways to generate trade ideas. This is just one of them. And again, when it comes to diversity in the portfolio, this is one factor that is very rarely talked about. As an example, if all your trade ideas are coming from just one process, that's a big risk, because if that process is flawed in any way or form, or if that process is not going to work for the next 3 to 6 months, then you're literally screwed, right? And this has happened, right? The process we'll be looking at now is the ISM. And the ISM has not necessarily worked that well in the last 2-3 years since COVID, etc. And if you were generating all your ideas from the ISM, you'd probably be broke by now. So you have to be very well aware of all these different sources of trade idea generation, and then pick the right ones and make sure that you have enough diversity in your portfolio. So every time you look at an idea, you need to be able to drill down and understand exactly what was the first point of contact that made you think about this idea. If it's the ISM, then you just label it as ISM. If it was, let's say, competitor earnings that you went through and then you realize the other parties in the value chain will also be impacted next quarter, you label it as such. But if it starts getting to the point where you're like, yeah, actually I heard this idea from a friend, or I heard this idea on YouTube or on a blog or on Twitter, then I think you're kind of putting yourself in harm's way, because these are very precarious positions to be in. You don't necessarily know exactly why you're long or short a particular company, and that's a very bad position to be in. So our jobs as traders, it's literally like this. We are confronted with a situation where we have more than 2,000 stocks listed in the US. Of course, these companies tend to be from a variety of industries, and we don't have time to go and look at 2,000 individual companies and update our thesis on them on a daily, weekly basis. That's going to be impossible for us to do. What we try to do is we say, okay, this is the opportunity set. We have around 2,000 or 2,000 plus listed stocks. Let's try to find high quality leads, and then we'll drill down further. So let's try to narrow down this tradable opportunity set from 2,000 plus to maybe 8, 10, and then we identify 3, 4, 5, 6 companies to look into. I think that's a more practical way of looking at things, as opposed to having a view on every single company, which will be impossible for us to do. Even if you have a bunch of analysts, a team of traders and analysts, it's an impossible task to do. So that's the process we try to implement, where I'll call it more of a top-down approach. So we start off with the broad market, then using the ISM, and I'll show you how to do that in the next few slides. Using the ISM, we'll identify actionable themes across specific industries and sectors, and then we'll kind of drill down specifically in these industries and sectors to find the candidates that are the most exposed to these emerging themes or trends, We'll research them throughout and then identify the actionable catalyst. And finally, our thesis will establish whether there is a high quality trade for us to participate in. If it's not a timely opportunity, we'll probably stick it in the watch list and then keep waiting until we believe the time is now right for us to have a live position in the portfolio. So that's going to significantly reduce your workload. It provides incredible direction and guidance in terms of why you're looking at a specific company. And of course, as traders, we always live in the future, right? So we're not going to be looking at information that's backwards looking or even sometimes coincident. Maybe we'll look at these two to establish the consensus around the industry and the stock. But then we always want to look at predictive information. So the ISM is a great source for predictive information, as we'll see in the next slides. Typically, this is the thought process of a trader. We try to establish the status quo, as I've discussed earlier. Then we focus a lot on what's changing in the story now and could affect future expectations. And then a third question we're asking ourselves is the market going to recognize this change? Or has it already recognized it and it's already priced in the share price? So as traders, this is the thought process. We're always asking ourselves these three questions and trying to answer them in the most realistic or practical manner. One thing to always say to yourself is there is nothing that I know that the market doesn't already know. So there might be exceptions to that, but I think it's safe for you to make an assumption that it's true in 99% of the cases. It's a little bit dangerous to pretend that there is something that you know that the market doesn't already know. It's a different question as to whether it's priced in or not. So this is where sometimes the market will price in something to a larger extent or to a lesser extent, depending on the type of benefit of doubt the market is willing to give to that particular company or situation. One example is during COVID, as it was becoming clear that the Fed will step in and the Fed will not allow any company to go bankrupt, or that liquidity conditions will be much looser and that will significantly decrease the risk of bankruptcies of companies, then even if you could see that some of the balance sheets were stretched and that the next 2-3 quarters would literally be very bad on a quantitative metric. So if you're purely a fundamental trader who looks at metrics like, let's say, interest coverage ratios and so on, and you make decisions purely on that basis, you'd probably be broke by now, because the market was like, okay, we see what's going to happen over the next 2-3 quarters. We know it's bad. We're happy to discount it. We'll give benefit of doubt to these companies. And then you would see companies like Carnival Corporation, Royal Caribbean, all these cruise lines that were looking like they would go bankrupt. These companies, the stock price of these companies was literally rallying 20-30%, sometimes in a day. So if you're not recognizing that the market is willing to just put these concerns aside because it believes that the Fed will step in and will keep monetary conditions loose enough, and you're looking at things purely from a fundamental, or I would even say purely from a dogmatic perspective, then you'd be in for a lot of trouble. So that's why it's always important to understand that the market has more information that you do. Whether it's priced in or not at the moment is really the question. And we see this a lot, right? Even with the CarMax trade that we've got at the moment, all the information that we were discussing is not news, right? If you look at my YouTube, I think a year ago I was speaking about these same things. So the market knew about every single thing that has transpired in the last quarter's earnings. We knew about that from 12 months ago. It's basically whether the market wants to give benefit of doubt or not at that particular juncture, based on what it's seen from the company as the last earnings. So going into earnings, maybe there was a lot of people or investors hoping that loan loss provisions or delinquency rates would have stabilized, or that management has a plan around that. And then once the earnings was out of the way, these same investors realized, but actually what's happening is delinquencies through the roof. Management has no lever on this. And it's a little bit even worse because now CarMax, in pursuit of more sales, it's actually now even giving loans to lower tiered customers. So customers that are not highly rated in terms of their credit scores. CarMax is now increasing exposure to that segment, all in the name of getting more revenue. So it's fairly easy to figure out what's going to happen over the next few quarters. And even if we're out of the trade, I'll keep updating you, and I promise you every single quarter will have issues around delinquencies. So the market is aware of all of that, right? And as the market realizes that, CarMax management is not necessarily taking the right actions, and it's going even, worse off in that direction. And on a macroeconomic basis, the backdrop is also getting a lot worse, where we are seeing the job markets weakening. So that correlates very well with increasing delinquencies in the future. And at the same time, you have used car prices that keep going down. So as the lenders have little to no to negative equity in their cars, the likelihood for them to repay their loans after they've lost their jobs is next to zero, right? And at the same time, if you say no, but maybe CarMax will be able to negotiate something with them, well, if you're negotiating with someone who's kind of hell-bent on not repaying the loan because the asset has no value, then good luck, because that's never gonna lead you to anywhere. It's a delinquency that will eventually turn out into a defaulted loan. So the market knows about all these factors, but as it's becoming more real, then it starts pricing it into the stock. Okay, let's focus more on the ISM reports now. So what is the ISM report? It's a monthly report that publishes the results of a survey of purchasing managers at the leading manufacturing and services US companies across a range of industries. So purchasing managers are the people who are making decisions on a daily basis in terms of how much inventory they will build for the company, how much raw materials they will order, and they're making all these decisions based on what's their view of demand from their own customers. So as an example, let's say if I run a textile factory and I'm seeing more orders, I'm seeing the sentiment from my customers being much higher, then it would make sense for me to start ordering more raw materials and start maybe stockpiling a little bit more inventory in anticipation of more orders into the future. And the opposite is also true. So these purchasing managers are being surveyed on a monthly basis, and these are from the top companies in the US. So I think it's the top 500 or something. So it's giving you a very good view of what these people who are on the ground, hands to the pump, what's their view, and what are the decisions that they are actually making for their own companies. And that's a very good it's a very good position for us to be in, because that's giving us information that's highly predictive in nature. So the responses are based on a few components. These would tend to be new orders, production levels, employment levels, inventories, supplier deliveries, customer inventories, pricing, backlog of orders, new export orders, imports, and so on. So I'd encourage you to pull up an ISM report and just go through it. It's not that lengthy. You can skim through it. You'll get a very good idea of what all these different components are. In most cases, we focus on a couple of them, but it also depends on what situation we're looking at. So as an example, in COVID times, when we had all these supply disruptions, I was starting to look at what's happening to inventories, backlogs, what's happening to, let's say, pricing, what's happening to freight pricing. It's not something that I would normally look at in a normal world, but whenever there's a specific situation going on, then I will narrow in on these different components just to try to get as much on the ground information from that. We also get qualitative commentary across all industries. Not every industry will give qualitative commentary every single month, so we have to be aware of that. The ISM indices are considered to be leading indicators for the future of future US GDP growth. So I haven't put the chart here, but if you were to let's say chart the ISM index versus GDP quarterly growth, and if you were to, let's say, move the index 6 months in advance, you'd see that the two correlate very well. So in other words, the ISM index rather, tends to predict what US GDP will be like over the next 3 to 6 months. So this is why we look at this report. It's highly predictive in nature. It's not necessarily been a good predictor in the COVID times, because that was kind of a unique situation where this report is capturing things that are not necessarily... So as an example, if you have a build-up in inventory, and that's because of a different factor versus in a normal world where inventory is built up, it's probably because they expect more new orders, right? So if people are building up inventories because they're afraid that in the next few months, maybe ships won't be able to come to the US, that's a totally different reason as to why people typically build up inventory levels, right? So we have to be aware of the backdrop of what's happening in the world at that particular point in time, and then interpret this report from that perspective. Keep in mind, it's just a survey. So interpret it accordingly with all the things that are happening in the world. It's not the holy grail, as I've mentioned a few times. So if you base your ideas purely off the ISM reports, there's a heavy chance that you would be wrong, or that your timing would be totally off. So we use these ISM reports just to identify these higher level industry themes, and then we'll dig deeper at a company level to figure out which ideas are actionable and which ideas are ready to go live in the portfolio. So how do we read the ISM reports? Across all these different components that I've listed, so in this case, we've got the services PMI and the ISM Manufacturing PMI report next to each other. And all these numbers are literally what we call, so the ISM it's called a diffusion index. So a number above 50 indicates expansion. A number below 50 indicates contraction. So I'll take an example. So in September 2024, the new order index for the manufacturing PMI came in at 46.1. That's below 50, which means that across all industries, the new orders index was indicating contraction. However, in the month before, in August, that same component came in at 44.6, which was even more contractionary. So in September, we're still experiencing contraction, but it was less than what we were experiencing in August. So the number on its own is not the only thing you need to look at. You need to look at it in conjunction with what's been happening in the past, and then try to understand what's the prevailing trend, what are the reasons behind it, and then from there onwards, you figure out what could happen next. You also get some qualitative commentary, as I've mentioned. Normally, I don't look at this that much, but because the ISM report has been highly contractionary, and we've been getting very good color from the people who put up these reports, I've started to look at these comments a little bit more closely. So essentially, as we've discussed in the Discord server, what we are saying is that a lot of companies are reporting that they're unwilling to invest in capital, especially in projects that require large capital outlays. They're also unwilling to invest capital in inventory buildups because there's a lot of uncertainty in terms of how the election will go, and also in terms of what the US Federal Reserve will do in terms of monetary conditions, right? So a lot of people, that's my feeling, a lot of people are kind of on the sidelines and waiting for a few key events to happen to understand or to figure out what would be the direction that they take from there onwards. So that's something we need to keep in mind and not kind of extrapolate too much on it, because this is also a situation where the market will look at this and say, it's not that companies are not willing to invest in large capital projects. It could be that once the election is out of the way and we've had a couple of US Fed meetings, that the companies will now all of a sudden come and start investing a lot more, because it's kind of, there's a lot of capital on the sidelines, and these decision makers are just waiting for a few key events to happen to get an understanding of how the future might look, and then on that basis they'll make decisions. The opposite could also be true. It could be that we have an election outcome that is considered to be adverse to a lot of these companies that were looking to invest and invest more in the US, build up inventory capital, invest in machinery and so on. And they realized that the conditions are not right for them to deploy capital. And then that's going to make the markets go the other way around. So we are at a very critical juncture. And it's something that we need to also understand as we are trading the markets, because once the election is out of the way, the market could go in a totally different direction. Because, let's take an example. Let's say Trump wins the elections. The market will immediately reflect the outcomes of a lot of policies that he's talked about, right, during his campaign. So as an example, he said that he'll get oil prices to go even lower to ease the pressure on the US consumers. So we know how that's going to go, right? He said he's got some particular policies around housing, particular policies around, let's say, eliminating red tape in the US in terms of, bureaucracy when it comes to doing business. So maybe investors will think that the US will become a lot more business-centric, business-friendly, and that would stimulate investment. On the contrary, let's say if the other party wins, then they've got a totally different set of policies. It's almost like diametrically opposite. So the market will reflect their views based on, those different policies that, the winning party will implement over time in the US. So that's why I say it's quite a critical juncture. We need to be paying attention at quite a few things, and the next few months could look very different from how things have been in the last couple of quarters. Another thing that I've been paying a lot of attention in these commentaries have been the percentage of manufacturing gross domestic product that have contracted in the month. So in this case, it was 77% of manufacturing GDP contracted in September, and that was up from 65% in August. So when we're looking at the index level, let's say we're looking at new orders that tends to be an average across all the industries. And this type of commentary gives us a little bit more color in terms of how bad or how not so bad things are on the ground. And from what I'm reading, it's indicative that things are quite bad, right? If you have 77% of manufacturing GDP that's contracting, and that's up from 65%, that's not a good sign. There's another piece in this same commentary that sheds a bit more light on the situation. So it reads as follows: the share of manufacturing sector GDP registering a composite PMI calculation at or below 45%, which is a good barometer of overall manufacturing weakness, was 41% in September, an increase of 8% point compared to 33% in August. So these two statements are telling us that things are quite dire in the manufacturing sector. We're of course not necessarily seeing news articles around this. We're not seeing maybe even the share prices moving that much. And it's also not heavily mediatized or covered, right? Even by the investment community. But these are real things that are happening on the ground, right? The question is this temporary? Is it just people waiting for the outcome of the elections in a couple of more US Fed meetings? Or is this the start of a much longer trend to play out over the next few quarters? So this is how we need to kind of set out and build our macroeconomic backdrop. And every idea that we're putting in the portfolio needs to kind of fit in with whatever we are reading, right? So if we're going, let's say, if we have a net short bias on manufacturing and we have a couple of ideas as shorts in the portfolio from the ISM Manufacturing Report, we need to understand that the risk we are taking here is that there is a big event happening in the next few weeks in terms of US elections, and things could be radically different after that event. Or it might be a confirmation of the weakness that we're seeing. Things keep going even lower. We also get a list of industries that are expanding and contracting, and that's provided in order of expansion and contraction. So we get this for each of the components. I don't necessarily focus on all of them. The ones I focus on tend to be the new orders index, the production level index as well, and also the ISM index, the composite PMI index. So what I will typically do on a monthly basis when these reports are out, I will update my Excel spreadsheet, and I'll show that in the next few slides. And so basically in the spreadsheet, I have all the different industries. And as these updates are coming out every month, I will update my spreadsheet based on the order of expansion or contraction of these industries. In September, we had these comments. So I'll read a few of them. So the ones which are in a red box, I think are bearish. And the one that's in the green box, it's showing expansion, and it's probably a bullish sign for that particular industry. So in September, we had a comment about the chemical products that gave us a little bit more color in terms of what's happening to the auto industry. So North America demand has started to weaken. Asian demand is slightly higher, but shows signs of weakness in future months. Comments tied to automotive builds. So I think I mentioned in one of my videos in the past that the chemical products is a very important industry to be looking at. So everything that goes into a car has some form of chemical product that is used with it. As an example, the dashboard will be made of chemical products. The lubricants will be made of chemical products. So chemical products tend to be the kind of the raw materials or the feedstock for many other manufacturing industries. And if the chemical products industry itself is seeing lower demand and weakening, it is a strong indication that demand across, further down the value chain for other manufacturing industries is also coming down. So chemical products sector showing or having contractionary pressures is not a great sign. Other manufacturing industries in the US. As an example, chemical products would also tend to be like plastics, a lot of other things, polystyrene and so on, that are used in packaging of goods that will be shipped off to customers. So that's a relatively bearish comment, and there was quite an emphasis made on the auto industry. We also got a bearish comment from the transportation equipment. So this would tend to be around autos or tractors or other things like EVs or any other companies that are involved in that value chain in terms of building cars, tractors, and so on. So global demand continues to remain soft. There was a particular comment being made around EVs. So the previously anticipated shift from internal combustion engine to electric vehicle technology has been pushed out due to market response. So the prevailing narrative in the media is that EVs will take over the world, EVs as in electric vehicles. But if you look at what's happening on the ground, the people who are actually building these are saying that we're kind of pushing this out because the market doesn't necessarily want as many electric vehicles as we thought they would need. And we've seen quite a few headlines in the last few months from a number of auto manufacturers who either they reduced their plans for building EVs, or they completely said, okay, we're going to make a 180 turn on EVs. We're stuck to internal combustion engines. That's quite different from what you hear in the media. And capital will also definitely move based on what's happening on the ground and not what you're reading in the media. So there are a lot of companies that are involved in this EV value chain, whether it's making batteries, components of batteries, whether it's making sensors, whether it's making semiconductors related to EVs. So that's a whole world in itself. And if you start looking at it, you probably will find very good ideas that could still have a lot of room for downside. And let's say in the next few months, we read a commentary that's indicative that this trend is reversing, then if you've already done the research, it puts you in such a great position for you to identify who would be the immediate beneficiaries of this reversing trend, right? So that's why it's important to always have your finger on the pulse of the market and to be updating your research, updating your knowledge base of different companies, industries, and knowing certain names within these sub-segments and knowing them inside out in terms of the business models, the competitive advantage. So you've heard me say this a few times before. No piece of research ever goes wasted. The more you research, the more your knowledge base is bigger, and the quicker you'll be able to narrow down and figure out who are the candidates that benefit or have significant headwinds when a specific trend becomes apparent. So I'll move on from this now. I think there was quite a bit of a bullish commentary around food, beverage, and tobacco products as well. Not going to look into that now, but the one that I thought was quite bullish was the computer and electronic products. So they were saying that the general slowdown that they are seeing in the economy in other industries is not affecting them. They are seeing solid growth. So I think this is an area that we have to start looking into and understanding exactly which part of that industry is seeing this type of growth. Is this related to AI? Is it related to something else? It's for us to figure out and, be kind of amongst the first people to the story. So as a trader, we need to have long and short trade ideas in the portfolio. Even if we are bearish on the broader market, we still need to have long ideas. And if there are companies demonstrating solid growth, they would go up even in the face of a generally declining broader market. And this is where, as traders, if we've done the work and we've identified where, there are areas with significant upside potential and areas with significant downside potential, and that the market is actually recognizing that in terms of having more dispersion in the market. If we position accordingly, we'll be making fantastic returns while never having to make a bet on where the S&P goes next. So, if you have 5 good long ideas, 5 good short ideas, the S&P could go up 10 or down 10%, and you could still be making money overall. And that's the kind of position we always want to be, because we have no edge in terms of predicting where the S&P goes next. It could trade sideways, it could go up, it could go down. But where we sit, we almost want to be agnostic to where the S&P will go and just pick ideas that are rooted in fundamentals and that have significant upside and downside potential. Build a portfolio of these ideas, diversify enough, and just let these ideas play out. The last comment I'll read here is still related to the auto sector. So we've kind of had 3 industries that commented around weakness in the auto sector, and it's predominantly auto manufacturing sector. I think the situation is quite dire, right? And the auto sector consumes a lot of things from other manufacturing industries. So that would be, let's say, batteries, it would be paint, it would be plastics, would be, let's say, rubbers and tires and so on. So when you're seeing weakness in auto manufacturing, because this sector takes up a lot of demand from other industries, you'll also start seeing this kind of weakness moving across the value chain and impacting these other industries as well. So in the case of primary metals, of course, if you're making fewer cars, then of course you're going to have lower demand for primary metals like steel and so on. So that's starting to affect the primary metals segment. And we could start looking for short ideas in primary metals. We could just use this commentary as a confirmation that auto manufacturers are not in a good spot. And now let me bring back all of this to our CarMax idea. So in the face of everything you've seen now, would you have the guts to be long CarMax? I'll open the floor for anyone who wants to step in. So my question is, would you have the guts to be long CarMax with the carnage we're seeing in the auto industry?
Not to answer the question with another question, but how could you be in light of what we've just discussed?
Mm-hmm.
Is the question more to get us to come up with a counter argument? Or
No. It's I'm not here to debate, right? I'm here to find the truth. There's only one version of the truth. I don't need. How do you say this? What's that word? I don't need someone to play devil's advocate. I only need the truth.
Okay.
You see, I'm very different in the way I look at things, right? I only care about the truth. I don't care about pros and cons. That's not my philosophy. What I'm saying is we are seeing very bearish commentary to anything linked to auto manufacturing. So of course, CarMax doesn't necessarily manufacture a car itself, but the reason auto manufacturers are not seeing a lot of demand is because as you move ahead in the value chain, there's a lot of inventory in used cars. Used cars are not selling. Used car values are down. And I don't know how much you know about the auto industry, but you probably have experienced it yourself, right? When you're going to buy a new car, a large part of these new car transactions are financed with what we call trade-ins. So what you'll do is you've got a car that's maybe 3 years old. You'll bring it to the dealership, and then you'll say, okay, I want to buy a new car, and I'll trade this in. Give me a value, and then the rest of the balance I'll just take a loan for it. But if you bring your car and then the dealership tells you, oh, it's actually worth $2,000, and you've already got a loan on that car, so the car itself is not worth much, which means you cannot finance your new car purchase with a trade-in. So can you see how that is just trickling down the value chain? So people have bought cars in the COVID era at elevated prices. 3-4 years later, those cars are not worth much. They cannot trade it in. And the auto sector, the cycle had always been linked to trade-ins, to used car values being up, and people having some equity in the used cars to be able to trade them in and buy new cars from that perspective. So when that's not happening, of course, the new car purchases will not be growing. And if new car purchases are not growing, the auto manufacturers will also suffer at the end of the day, right? So something that we identified from the used car segment is now allowing us to have a read on the entire value chain. And that could allow you to be short, let's say, an auto manufacturer, short a company that provides semiconductor or electronic parts to the auto industry. And there are so many opportunities that come from just understanding how the whole value chain is set up and what's going to happen next. Is that clear, Haider?
Yeah, thank you.
So the whole point I'm trying to make here is, as traders, we're always trying to be closer to the truth. We'll never be like 100% spot on, but we want to be closer to the truth as far as possible. And the reason why we look at these reports and interpret them correctly with the backdrop of everything else that we know, that's because we want to be able to have a good probability of being able to predict successfully what's going to happen next in certain industries and for certain companies. I think I'll kind of skim over this. I've probably already spoken quite a bit about it. When we look at the different components, I did mention that I typically look at just the 3 of them. Sometimes I will look at others. Like, let's say if I want to understand what's going to happen to inflation, I'll look at the ISM prices. If I want to understand what's going to happen to employment sector in the manufacturing domain, I'll look at ISM employment. But traditionally or typically, I will look at these 3 components. The broad index, that gives me a high-level view on a particular industry. The production index, so that will tell me what's happening currently. So are production levels increasing or decreasing? And then finally, the new orders index. That's where the majority of my focus will be, because this has true predictive value. New orders will become future production. So if I want to understand where the world will be in 3 to 6 months' time, I need to understand what's happening to new orders. Is that something that's clear enough, or do I need to explain a little bit more?
A little bit more would be helpful. Thank you.
Okay, so think of it this way. You're running a factory, right? you get new orders. Let's say you've got new customers that start ordering stuff from you. Now you have to manufacture those products. So as you get new orders, that increases your backlog, right? And then once your backlog it has reached a certain level, you probably will say, okay, we need more employees. And then you also will look at your inventory and say, okay, if certain raw materials are not available locally, we'll have to import them. So everything that you see in this segment, everything here is literally the different components, or literally the different components of the ISM report. So new orders increases backlog, increases employment, increases imports, increases inventories, and once all of that's done, it will increase production levels, which will increase the deliveries that you're making, and that could increase the level of exports as well. And eventually it will increase your customers' inventories. That's kind of the logical flow of things. And it might not apply exactly like this for every single industry, but as a whole, this is how you need to be thinking about it. So does it make sense when I say new orders are highly predictive for future production levels and all these other components? Can you see why? Anyone?
Yeah. Yeah,
So
makes sense.
So the reason I'm spending a lot of time on this is because this needs to become part of your instinct. It has to become second nature, because you have to, as a trader, you always have to think of the trickle down effects, the knock on effects of everything you're reading. Because if I told you, let's say, production levels are falling for a particular industry, is it bearish or bullish? It's not necessarily bearish, because it might be that next month production levels will go up for the next 6 months, because new orders are in now and the rut that we've been in for that particular industry is now over. So that's why we always need to have our eyes on the future. And what gives us a very good sense of what's going to happen down the lane is the new orders index. We have to keep in mind that this is dynamic and that the purchasing managers are making decisions day in, day out in response to all these above factors. We also have to keep in mind that this is a survey, right? So it's kind of prone to people's judgment. So we have to keep in mind that even though these purchasing managers work for large institutions, and they would be very experienced individuals, at the end of the day, there's a little bit of judgment, a little bit of subjectivity that is introduced into this report by virtue of it being a survey, right? So that's why we don't look at the ISM report as a holy grail, but rather we look at it in terms of can it help us understand what's happening under the hood, and identify a couple of industries where there might be opportunities for longs and shorts. We also need to keep in mind that externalities can have significant influences. I spoke about COVID, where we had the supply chain disruptions, high freight rates. A lot of the commentary in the ISM reports back in those days would be around these factors. We also have industry regulations. So as an example, let's say there's a specific industry regulation, let's say you're not allowed to use a specific type of heater, or that all heaters in houses need to be at least 10-year-old. It would create demand for heaters, right? Because if you had buildings and houses that had heaters that were relatively old, these would need to be renewed, whether there's a recession or not, right? Because regulations are mandating that. And you also have things like tariffs. So trade tariffs, this is something that has been in the news quite a bit, not just in the last few weeks, but it's been happening at least from when Trump became president last time. So he was the one who put a lot of focus on trade tariffs, and he's been quite vocal about it, and he's still quite vocal about it. So these factors do influence what's happening in those particular industries. And it's our job now to kind of marry what we are seeing in the ISM reports with a lot of these externalities that could impact individual companies within these industries. So let's get a little bit more practical now. Let's look at the ISM PMI September 2024, and predominantly let's look at the new orders index. What I've got here is a snapshot of the Excel sheet that I update on a monthly basis, and we're covering 12 months here for different industries. So again, what's circled in red is bearish from my perspective, and what's circled in green would tend to be a bit more bullish. I've got a couple of industries that I've highlighted as bearish, namely machinery, apparel, leather and allied products, printing and related support activities, paper products, electrical components, electrical equipment, appliances and components, and transportation equipment. It doesn't mean that I'm not bearish on other industries. The data is there for you to make your own interpretations. I might be wrong, I might be right on a couple of them. But at first look, this is kind of my view. Now you could ask me, but why are you not bearish on plastics and rubber products? Why are you not bearish on wood products? It doesn't mean I'm not bearish. It just means that I've kind of selected a few industries where I think the probability of being bearish is, probably higher than in other segments. One thing that I'll come back to this snapshot later. One thing that I always need to highlight is that our job is not to look at just 1 month. Our job is to try to identify industries where dynamics are changing. So let's say if we were looking at, let's say, paper products. So many months of relatively good expansionary pressure or relatively high expansionary pressure, a couple of neutrals, then expansion again. And then we have 1 month where it's the contraction is starting. So that's something that gets my attention, because I'm going to be looking out for this next month just to figure out whether there's a confirmation signal that we're getting in terms of maybe a new contractionary trend starting. The same thing for printing and related support activities. So a couple of months of expansion, then neutral, and then 2 months with relatively high contraction. So as a trader, what we want to do is to be able to identify real emerging trends. We don't want to just look at 1 month and then, take the risk of having identified a very short-lived one-off movement. And you will see that in many cases, even if you have, let's say, let's take an example for computer and electronics, right? It's contractionary over here, then a few months of expansion, then you have a neutral month. So if you were assuming that, maybe the expansion is over and we'll come back to these contractionary months, and you were short in this segment, you'd probably be wrong. So that's why we don't just look at 1 month and then, just make a haphazard conclusion. We try to establish whether that's a real emerging trend. And sometimes what we'll do is we'll wait for 2-3 months in a row as a confirmation signal, while at the same time also doing a little bit more deeper dive industry research. What we also focus quite a bit on is to be mindful of the prevailing narratives within a particular industry, and then we'll evaluate that versus, the consensus or the status quo. So if we're seeing something that is divergent and significantly divergent in the ISM report, and narratives on the ground or narratives in the media or even across the investor community is highly diverging, we want to focus a little bit more here because, as I've mentioned, we want to be closer to the truth, right? So if the narratives will eventually converge and indicate that what the investors were thinking was probably wrong, then share prices will move accordingly. So we want to figure out what's the truth before everyone and position accordingly. And as these narratives start changing, because things on the ground are actually pointing to investors that they are wrong. And keep in mind that investors typically would get data on a quarterly basis through quarterly earnings. So there are many months where they will not necessarily be, in touch with the market because there's not a lot of forthcoming information that's being provided by their particular companies. So that's when we need to be evaluating whether the consensus is right or wrong, because once we have earnings that make it obvious that a particular company is not going to grow or is not doing as well as investors were thinking, then we'll have a lot of downside potential in these types of stocks. And that's the kind of opportunity that we are looking out for. It's not the only type of opportunity, but it would be one of them, right? Another thing I wanted to mention, and after this we'll go deeper into these industries and try to find actual ideas, or I'll show you how I would recommend you start off your research journey. So before that, I wanted to mention one thing. You probably would have looked at these industries and figured out, what does paper products mean? That in itself is too broad of a label for me to understand exactly what that means. What does plastics and rubber products mean? If you're ever in doubt, in the US, you have this North American industries classification system. Google is your friend here. You can just Google it, and then on this website you can put this particular industry label here, and then it will break it down for you. If you scroll down here, it will give you the sub-segments and literally all the companies that are registered within that particular classification system. So in this case, what I've done is I've searched for commercial printing, and it's given me a lot of companies here. And if I were to scroll down, I would get a lot more color in terms of what constitutes this particular industry. So as you're starting out, I would highly recommend for you to play around with this if you're in doubt and you're not necessarily 100% sure what certain of these industries mean. Because you might be looking at a particular company and you're looking at the totally wrong company for that particular industry or for that particular trend that you're trying to investigate further. Let's look at the printing and related support activities industry more in detail now. So we've seen that the new orders have been highly contractionary in the last 2 months, right? And if you look at June and July, it did not really indicate any form of expansion. So it's likely that June and July were a bit of a transition period, so stagnation, before we get contractionary months ahead, right? So that for me is a little bit of a confirmation signal that maybe we are entering into bearish territory. And if I look at the paper products, which is, you would agree with me that paper products and printing and related support activities would be kind of related to each other, right? So if I look at the paper products segment, we've had a few months of expansion, then a couple of months of neutral, maybe stagnation, then resumption of the expansionary months, and then we have like 1 month where we start seeing contraction. So if I evaluate these two industries together, And if I'm seeing that the printing industry is starting to contract, is it reasonable to assume that as printing and related support activities are contracting, the demand for paper products is also going lower, which is causing a contraction in paper products? Maybe that's right, maybe that's wrong, but from my perspective, that's something worth investigating. Do we all agree?
Yep.
Is that making sense, or are you kind of scratching your heads? Just give me a sense of what you're thinking.
So far, so good. It makes sense.
Okay. So is that something that you probably would have picked up just by looking at it on your own? Or is it now kind of clicking because I've mentioned it?
Clicking because you mentioned it.
Right. And I mean, this is kind of what you'll have to do on your own, right? And you'll become a lot more conversant with this report. The more you look at it, the more you've found ideas, the more you've played with it. And you'll start seeing these things emerging, and it will become a lot more obvious to you. Another example would be apparel, leather, and allied products, right? And then we've got textile mills. So these two are related to certain extent, right? And when we're looking at these industries, we probably should look at both in conjunction and try to figure out what's happening, whether there's confirmation signals or whether anything is divergent, because that's kind of helping us to get closer to the truth, right? As traders, there is a big risk that we run in that we're always looking for ideas and wanting to find something as quickly as possible, which means that kind of puts us under pressure of becoming a little bit trigger happy, and we kind of jump at the first opportunity that we see. And sometimes what happens is we see things that are actually not there, and this is something that we have to be very careful about. And the reason we are starting to see trends that are not actually real or not even there is because we're just wanting to get a trade idea out of everything that we're looking. If we learn to dissociate effort and time linked to research with how many trade ideas that are actionable that we're able to put in the portfolio, if we dissect these two, we keep them apart, that's a very good start. If we start saying, oh, I've been looking at something for the last 5 hours and I haven't found any ideas, this is not a good place to be, I really, really, really need an idea, then you're likely to be, to start putting pressure on yourself, and you'll see things that are not necessarily there. And as a result, your trades will also not work. So moving back to this slide, we've seen contraction in the new orders for 2 months, right? And before that, we had a few months of relative stagnation. So what we can safely assume is that segment has probably lost steam. Now, if we look at the production levels and we go back to the printing and related support activities segment, so production is, just to put things in perspective, production is what's happening now, right? And if we go to the production component, we've had, since the start of the year, we've had a few months of stagnation. March showed quite a bit of expansion, then stagnation again, expansion again. So it was relatively healthy until July, right? Then in August, we have 1 month of stagnation when it comes to product levels. It doesn't mean production levels have gone down. It just means that it hasn't increased from July. And then in September, we have a highly contractionary month. So production levels are starting to go down. And if we look at what the new orders index was showing us, if you look at June and July not having increased from May, and then August being a negative. So you're starting to see this weakness actually being reflected in production levels too, right? So are you able to make the link that I'm trying to showcase here?
Yes, that's right, Rashad.
So
Just one question,
Yeah.
when like in the new orders, there is back-to-back contraction, right? So the second contraction is from the previous month, or like
yeah.
that's how we should.
It's month on month. Yeah.
Okay, wow.
But
Okay.
one thing is, you should not read much into the magnitude of the number, right? The magnitude of the number is just the rank in terms of the order of contraction in that particular month across all the other industries. So don't look at the number as being -10 being, really big. So, that's something that's bad or really, really bad. Don't interpret it in that manner. Although it probably indicates that, it's not necessarily positive, but don't read too much into it. I think what's quite telling here is how we see these new orders. So remember, at the start of the conversation, I said new orders have highly predictive value for other components of the ISM, right? So I've established this particular chain here, right? So as we start to have a few months of stagnation and contraction in new orders, it's normal that we start seeing production levels also starting to contract, right? And this is kind of a confirmation signal, if anything. And that's where, as a trader, you're looking at these reports in a very different way to, let's say, a common layman person. So a layman would look at this and not come out with anything. But you're looking at this report and you're able to find trends that are real, that are emerging, and probably not yet reflected by share prices, right? And for the layman who doesn't understand the framework of how everything is interconnected, what's leading, what's lagging, he's not going to be able to make that link, and he's only going to be reading newspapers and finding out about things that have already happened. What we try to do as traders is to be the guys who are participating as things are unfolding in real time, right? So you would have seen my quote in terms of smart money prints the charts and dumb money reads the charts, right? So this is literally what I mean by that. I hope that sinks in, right? So the question you would be asking yourself, okay, now that we've established these links, what does it mean for us? What do we do with that information? So put your thinking caps on now, right? Printing and related support activities. What's the value chain of that industry? So you'd have printing equipment manufacturers, the likes of Xerox, HP, Dell, all these other printers that you see. The problem is not all of them would be listed in the US. Xerox is one of them. You feel free to just get a stock chart for Xerox. You'll see that it's not been in a good place. You could also say, okay, let's move on from printing equipment manufacturers. Who's down that value chain? So you have a lot of companies involved in commercial printing. So commercial printing would be things like you're printing labels for goods, you're printing on packaging, you're printing on even, like these custom mugs, custom t-shirts and all of these things. You have a few companies involved in that segment. Simpress is one of them, CMPR. You would have heard me harp on this a few times in the Discord server, and for very good reason. I'm hoping that everything is kind of falling into place as I'm discussing this, and that you're able to see the reasoning that goes behind, finding a company like Simpress. It's not that, I knew about Simpress for like the last 10 years and now because I know about it, I'm going to suggest that you should buy or short it. It's a company that I've only started to learn about probably, last year. And, as I know a lot more about the company and I'm seeing these trends, it comes back to me, and I'm like, okay, the way to play this emerging trend would be to look at Simpress and see whether there's a short opportunity here. Another company called Ennis, EBF, it was down 17% last week. Do you even have to guess why when you've looked at the ISM report and what it's suggesting? I think it's pretty evident why it was down 17% last week. So if I'm telling you it was down 17% last week, you're basically like the layman who's just reading news. It's already happened, right? As a trader, you should have been in the trade, right? You should have been the one who said, this company went from 24 to 20 last week. I've made 300% on it. Or I've made 17% leverage 3-4 times. I was short this company. So that's the big difference between being a layman and being a trader. You need to be participating in what's happening, what's unfolding, and not be the guy who's reporting. Leave that to reporters. We've got lots of them. We are the ones who want to be ahead of the curve and to be participating. We could also be bearish on paper manufacturers. So as we've seen, we've looked at the paper segment too. Paper manufacturers would be companies like International Paper, IP. There's another one called Silvamo, SLVM. So now keep in mind that these paper manufacturers don't just manufacture like paper, right? They get involved in a lot of other products like packaging products, like container boards, etc. So as you're doing your research into these companies, you need to understand exactly what are they exposed to and how much of their exposure is linked to what you're seeing in the ISM report. Because if you were to look at, let's say, Silvamo, it's a company that trades at a higher PE versus its peers. And you have to ask yourself, is that premium that the market is giving them, is that warranted? Why are they trading at a higher PE versus their peers? Why is the market willing to pay higher for that particular company? And then once you've established those reasons, you should ask yourself, are these reasons going to stand true for the next, let's say, 1 to 3 months? If there is something on the ground happening that suggests that these reasons are no longer going to be true, then there is a short trade idea, or there's a potential for a short trade idea here, because the entire investment community have built up a consensus on this particular company that's probably not true, or is probably outdated, and it's not going to be relevant for the next few months. So as more information comes out in terms of earnings reports and so on, investors will look at this and then look back at their thesis and their assumptions and figure out whether their thesis is being validated or invalidated, and make buying or selling decisions on that basis. So this is literally what you're trying to do as a trader. You're trying to get closer to the truth and kind of position yourself ahead of these big institutional money making buying and selling decisions that will move the share price. I'll move on to another industry, or maybe I'll open the floor for any questions that anyone might have here. Please go ahead.
So this is something that you've commented on a couple of times in this video and the last one.
Correct.
But there's been mention that it's wrong to assume, or very dangerous to assume, that you know something the market doesn't.
Mm-hmm.
At the same time, there's been commentary that the market may not have incorporated the information into the share price.
Mm-hmm.
My query there is, what's the gap between the two? And Yeah, effectively, what's the gap between the market knows versus price, and how we play and how our timing and knowledge plays into that?
Yep. So that's a very good question. It's something that as traders we keep asking ourselves, right? We know that we don't know anything that the market doesn't already know. We accept that as a truism, and now we're also setting out, taking positions in the market, assuming that we know about a few factors that will move the share price, right? It can feel a little bit contradictory, but it actually isn't. As I've mentioned before, there is a gap in terms of knowing about something and then whether it's actually priced into the stock or not, right? So it's not very different from us as individuals, right? Like, let's say we're working for a company. We know the company is shit. We know the business that it's involved in is going down. But because we have personal stake in it, we've been working at that company for a few years, we tend to have a little bit of optimism that things will improve, right? And we cannot be cold-heartedly objective. So we keep working for that company. Every month the numbers are coming out and actually telling you exactly what you knew like 5 months ago, but we still don't leave that company. We keep working for it, and then eventually coming to November you realize this position is unsustainable. The cash levels are depleting. Like, customers are not happy, customers have left, and there's not any glimmer of hope for that company. And then eventually you decide to leave that company. So can you draw a parallel with what I'm trying to say in terms of you have an investor
Yes.
base that's kind of looked at a situation a few months or even a year ago, made a few assumptions, and then they've taken a position in the market, and then periodically they'll keep reassessing a situation, not just at a company level, but also at an industry level and on a global basis. What's the macro environment like, and so on. And investors tend to be optimistic, especially equity investors. So they'll even try to find, opportunity in something that could go bankrupt tomorrow. That's equity investors for you. So when everything is going well in the world, they're like, yeah, I can see the temporary headwinds. They will sort themselves out. That's fine. I'm still happy to have this in my portfolio. And then over the next few months and quarters, when the numbers keep confirming that, it's not going well, or that, let's say you had assumed that Silvamo, for instance, will increase earnings 20% every month, or 20% this year, and then 25% next year. But then when you look at the industry level, you're seeing there's a high probability of a recession, and that's probably coming from the goods economy. Manufacturing is at its lowest it's ever been. It's not growing, which means you'll have lower demand for packaging, you'll have lower demand for paper products, you'll have lower demand for everything related to the goods economy. In the face of all of this, it becomes very hard to ignore what's going to happen for that company. It becomes so obvious, right? And that's when it's possible that people will still not make any decision. If the share price keeps going up, they'll be like, yeah, maybe the market is kind of giving benefit of doubt. But what's happening is a lot of the other investors are already jumping ship. They're already offloading that particular company. And it will only start appearing in the share price as more of them start selling their stakes. Every quarter, as you have results that are disproving the assumptions that you've built into your thesis, and that other people in the industry have kind of been group thinking and building in their thesis, it becomes so apparent, and then the share price will have to kind of bridge that gap between reality and expectations. So That's why it's not an exact science, right? It's not something you can just write a formula, build in a spreadsheet, and say, okay, run that algorithm, and then find all the winners, find all the losers in the market. Let's go long, let's go short. It doesn't work that way. There's a lot of work that you have to do on a fundamental basis to establish the truth. And then there's a lot of work you also have to do in terms of understanding the positioning of the market and whether, capital is going to move within your chosen trade horizon. As an example, let's say you decide to short Silvamo today, and your trade horizon is 20 trading days, but earnings is only happening 50 days later. And then you come back to me and you're like, yeah, I decided to short Silvamo based on your presentation, and it just went up by 5% in my face. So what happened there? I'll be like, but there was no catalyst in the period that you've chosen. You should have just put it on your watch list and then wait for earnings to be within your trade horizon and then executed the trade. And it's very likely that earnings, once you get more confirmation that the industry is contracting, you will start to see the share price moving. Is that clear? It's something that's very difficult to grasp, and it's a very, very good question, Heide. We all struggle with that at the beginning because we always feel like, yeah, but I'm reading the same thing as anyone else. There's nothing special that I'm doing. Why is it that I'll have an edge in terms of, trading the markets in this particular way or not?
Thank you so much.
Now, let's not be gloomy. Let's look at maybe a potential for a long. So you would have seen I mentioned the computer and electronics products industry as being one where we're potentially seeing a few good things. So most particularly, if we go to the commentary section, so in September we had a positive commentary, and what I've got here at the bottom, it's basically the commentary for this particular industry from other reports in the past as well, including September. So you'd see that in September they're saying we are seeing solid growth. And they're kind of also saying that the general slowdown in the economy is not affecting them. So if we go back in June, they were saying that orders are still steady, inventory is enough to satisfy current and near-term commitments. So kind of neutral, but slightly bullish neutral commentary. In May, they were saying orders have started to rebound, but inventory levels remain high enough. So they were not concerned that orders are coming in and that they probably have lower inventory levels to fulfill these new orders. So they were quite happy with this situation. And if you go further down, you'll see in March, they were saying that demand remains slow. So demand is soft, but optimism is high that orders are just on the horizon. So if you go back in history and you pretend you were in March, you're reading this. This is probably a time for you to start researching this particular industry. When you read this in March, you should start thinking about this particular industry as having a few long opportunities, right? It's telling you that demand is soft, but there's optimism. And then you go into April and you start getting indications of improvements. And then in May, you get a bit more bullish in terms of the commentary, which says that orders are starting to rebound. And now we're in September and they're saying that we are seeing solid growth. So this idea, you're not early to the party here. It started in March, you got confirmation in April, and then in May, and eventually June and September were basically just confirming everything that they had been indicating in the past. So if you look at the new orders, we've got expansion, and it's not new. We had expansion from February onwards. So we had a few months of expansion, then neutral, and then expansion again for June, July, August, and now September. So here we're not looking at a changing trend. We are basically seeing a continuation of a particular trend. And if we look at production levels, I think it's over here. If we look at production levels, we'll see that that's also been up, which is a good sign for, an area where we're looking for longs. And then, as I've mentioned, we've got sustained bullish commentary for a few months in a row. So all of these is kind of painting a bullish picture for the industry. And now our job is literally to go and figure out what's driving growth in that industry and which are the companies that are most exposed to these themes that are driving the growth. So what I like to do is always look at the value chain of that particular industry. So if you look at the compute and electronics products industry, it's probably good you split it in two. So just look at computer products. So of course you'll have manufacturers, you'll have a lot of original equipment manufacturers that provide supplies to the computer product manufacturer itself. And then those products move to, let's say, a wholesaler or a commercial distributor or a retail distributor. And within all these segments, there are a lot of opportunities that you can find. And you can even narrow down your research to that particular segment where you believe there's most opportunity. So as an example, maybe there's not a lot of opportunity in a company like a computer retailer, but there's a lot more opportunity in looking at the enterprise space. So any sort of commercial distributor might be where you should be focusing a lot more. And it could be that a lot of that demand is coming from, let's say, the enterprise sector now picking up on the AI investment theme. So basically data centers, basically enterprises which are, increasing computer equipments within their servers, etc. So if you narrow down your research to that segment, you might realize that this is where a lot of the action is focused. And you're bound to stumble upon a few companies that will eventually be very good long ideas. How could you do this practically? So what I've got here is a snapshot of FinViz. It's a relatively good screener for US stocks. So what I've done here is I've filtered on computer hardware companies, all in the US, and then it gives me a list of these companies. What I've got here is those companies are listed in order of market caps, the higher one being at the top and the lowest ones being at the bottom. So if you look at the performances over the last month, month and quarters, it's been relatively good across the sector. So that's a good kind of head check in terms of whether this is a good place to start looking for a long idea or not. You could also narrow it down by electronic components. So within this industry field, you could choose electronic components. That gives you another list of companies, and it's for you to narrow it down a little bit further and figure out where is it that you could find a bit of opportunity from a long trade perspective. And then you could also narrow it down by a slightly different industry in terms of electronics and components. So again, you'll get a different type of company here. So within these free filters, if you pick, let's say, a couple of companies to start researching, you'll get a very good idea of whether there's a long opportunity or not. But that's how I would kind of suggest you go about it. Once you've established the trends from the ISM, then you use a screener like FinViz or something else that helps you to narrow it down even further to the companies that could be exposed to the themes that you've identified. And then you drill down, you start doing your own research, whether it's in CoiFin or you go to the investor relations site for that particular company. try to get as much information as you can, and then figure out whether there's a trading opportunity or not. So that's it from me. I'll open up for any questions that you might have for me.